everybody, it's Boris Schlossberg. Well, we survived the eyes of March and we survived the Fed in a grand fashion. I don't think anybody at the start of this week could have predicted the V-shaped bounce we've had in equities after the Fed went out there and became so hawkish in its policy structure, even despite the fact that we have all this geopolitical risk still in the system. So I think the single biggest surprise, and one that we really have to respect, is this V-shaped bounce in risk that suggests very much that we're now back on to a upward trajectory in equities. Probably, I guess, the 15th thou is going to be the next major resist point. We certainly could get a little bit of chop back and forth. And of course, the geopolitical situation could darken significantly, and that could have a big shock on equities. But the fact that we're able to shake off so much bad news is extraordinarily bullish. I came out that the day of the Fed decision, I said, you know, the single most bullish thing would be if the Fed hikes, stocks drop, and then just rally hard, because that means the market is really shaking off the interest rate raise and essentially betting on the fact that growth is going to continue. To me, the fact that risks is popping up so hard is probably the single most interesting signal from the market as we're looking at trading going forward. Now, we don't really have anything of import next week as far as macro goes. I mean, literally, it's just conversation. We have Lowe speaking, we have Powell speaking, we have Bailey speaking. Really nothing much. They're very likely going to stick to the stories that they told us in their pressers, posted their interest rate decisions. And the only thing I think of as far as of note would be the German flash PMIs, which are likely going to be negative. And we'll take a look at FX in just a minute. But I do think Europe still looks like it's very vulnerable to an economic shock, given what's going on in this region. But for the U.S., the power of tech really keeps powering on. Now, this 1440 certainly is a big resist level. This is the monthly high. We'll see how it acts. It's very likely next week is going to be sort of less interesting as far as trading goes. It's very likely we're going to be entering into a chop. Again, assuming that there's still a stalemate going on in Ukraine. If the situation moves one way or the other, volatility is certainly going to be a big factor in our trading. But be that as it may, for now, I think the single most surprising and interesting aspect of the markets is the fact that it's risk on in equities. And pretty much, I think every dip is going to be a buy. So if we do get a move back down to the 14,000 next week, it's probably going to be an interesting entry level with generally basically watching the lows of this market. These are the yearly lows, by the way, at around the 13,000 level, essentially assuming that we've made the lows for the time being, and we're going to try to churn back up as we go forward. Now, turning to oil, which has been a fascinating market. One of my conjectures last week was that, the week before that, we got to be as sellers of oil because this is ridiculously overbought in a scale-up fashion. That worked out really beautifully. And then last week I said, now we got to be scaled-down buyers, which also worked out very well, where, if you were a buyer at 105 and buyer at 100, buyer at 95, because we stopped very much essentially right at the monthly lows at this support level here. But again, I think oil looks to me like a very reflexive trade at this point, a little bit of consolidation. Very likely we're going to see volatility contract a little bit. And all of this, again, with a huge qualification that if the news from the front somehow becomes far more pressing, then yes, all of this goes out the window. But assuming we're at a stalemate, I think volatility, you're already starting to see volatility dampen a little bit. And it's very likely we're going to be consolidated. But for now, this is bid. Right now, this 95 is support. You have to respect this level. This big trend up in oil held. We're essentially going to probably bounce around there. And I think long-term, you have to respect the fact that so much oil capacity now is off-market. 20% of Russia's production is probably going to be stalled. One of the interesting things I heard today, which was fascinating from a guy who trades oil, is that as nobody's taking Russian oil deliveries, that means oil in Russia is getting stored, and they're going to run out of storage. Now, once they run out of storage, they're simply not going to, they're going to have to shut down capacity. They're going to have to shut out pumping because they're going to have no place to store it. And if that's the case, you're going to reduce capacity in the near term. It's got to be bullish oil. Very hard. I mean, obviously, if we break 92s, I'm wrong. But I think from a fundamental point of view, you have to be essentially a dip buyer anywhere here on the assumption that we still have more gas to go in oil. No pun intended. Gold also acting relatively well. So, parabolic spike, that was a great short over here off the 2000s, 2001. But again, here we are consolidating. Here we are finding support at the 1900 level, which is a very decent support level, I think. And again, this is a structure here that suggests we probably have a little bit more to the upside to go. One, I think, interesting unknown here is, what will the Russians, will the Russians actually begin dumping gold in order to generate hard currency? That's one macro event that could really derail the bullish idea. And to me, I think the key way, gold should be a cautious buy at this point, with a full realization that if we break the 1900, in other words, if we take out the lows here, it's very likely it could flush all the way down to 1800, because that would probably mean that we have margin liquidation or a big seller liquidation who's just simply looking to liquefy. So far, it's been at a stalemate with support at 1900 and trading relatively well, essentially on a, I think, intraday basis. But we'll have to see this. Generally, I think the theme you see from me next week is that it's not going to be very exciting. I'd love to be proven wrong, but my suspicion is after so much volatility tends to be very mean reverting. Once you have huge moves up, huge moves down, you tend to calm down a little bit and it becomes a range trade. And as a matter of fact, if it is a range trade and you sort of push yourself into a range environment, then you're essentially buyer at 1900, seller at 2000 here in a broad range of gold, as the market just essentially waits to shake things out. Now, speaking of low volatility, speaking of just, volatility dying on the vine, nothing has been deader than crypto for the last month. It's ironic that in this period of the most intense geopolitical risk that we've had in more than 70 years, when you would think crypto would be the flock asset that everybody would go to, it's actually acting like a utility stock. Most of the crypto analysts that I speak to are essentially just telling me it's a 35-45, and until either side breaks, there really is no trend. I will say that the chart looks pretty healthy actually at this point, and some of the people in crypto that I talked to were actually relatively bullish here because the support is held. We've taken the midpoint of the monthly highs and lows. That's pretty bullish, and actually if we close here on the day, that's going to be a relatively bullish move. So given the chart and given the buying patterns, it's likely that we could extend a little bit further up. Now, crypto, of course, is much more of a risk asset than a risk-off asset, and it's starting to trade in sympathy with equities, which are rallying strongly. So you have to believe that if there's more juice left to the risk-on trade, this trade has a little bit more extension. But overall, it's a very, very quiet asset at this point. Nothing really much is moving. It's interesting that, ironically enough, as it becomes more institutionally validated, people were talking about the fact that President Biden has issued an executive order on crypto, essentially in some ways validating its value. The irony of the whole thing is the more it becomes institutionally accepted, the less interesting it becomes as a volatility asset, and we're just being very, very quiet at this point. So I think this volatility signature in crypto, which has been very quiet since the beginning of the year, or since really February, pretty much going to remain. There is nothing to do here except maybe trade to the top of the range or the bottom of the range and make mildly bullish bets on continuity to the top here. That's really all you can say. There's no real fundamental triggers here. There's no real big narrative stories. Everybody seems to just be holding, not really moving it. And we'll leave it at that as far as that asset class goes. Now, FX, on the other hand, is starting to really pick up. And one of the interesting things about FX, I think, that everybody needs to appreciate is FX has been a dead asset for a decade because interest rates have been at zero. And the one thing I think we can all confidently say, at least for this year, is that there's ZIRP, zero interest rate policy, is no longer on the table. as rates expand globally, that means Bank of England, even perhaps maybe someday Bank of Japan, certainly RBNZ and RBA, and of course the Fed, all begin, and BOC, all begin their rate hiking cycle. As rates expand, FX becomes more interesting because FX is always about yield, right? Currencies are essentially nothing but glorified short-term bonds. So the more they start yielding, the more they start trading. That creates, I think, more interesting moves. Let's take a look at the mains, and then we'll take a look at some of the thematic trades that everybody has been involved in forever and see what's going on. On the main side, Euro looks pretty good. The 108 spike here has been made. Now, a lot of people are essentially shorting this 110, 111 move on the assumption that the news out of Europe is really going to be pretty bad as far as the economic situation goes. And of course, there's going to be a big differential between growth and even rates, U.S. to Europe. But so much of that has been kind of factored into this big decline. That I do think, I think it's not a bad idea to sort of short the tops here because this is a clear, near-term range top. It may be interesting to step in front of those German PMI numbers, which are very likely going to be disappointing given the incredible contraction of consumer sentiment and demand. But, and this is a little bit macabre, I'm the first one to admit it, but you have to look at it from an investment point of view. You have to actually appreciate the fact that war is generally very bullish capital stock, because if you think about what happens in war is that you have a destruction of a lot of capital, which means you need to have investment and rebuilding. That usually tends to be very stimulatory to the economy. So, and also, of course, any hope, which we all desperately hope, of cessation of activity, cessation of hostilities, and even in best case scenario, perhaps a ceasefire and some kind of a peace agreement would be very, very bullish. That would really convert, I think, this uncertainty bounce into a much more bullish move higher, because that would suggest, one, the elimination of the geopolitical risk, and then two, massive rebuilding, which is very fiscally stimulative, and I think should be very positive, especially for Europe, where so much industrial stock resides, and especially for Germany, which is the heart of industrial production. So I'm not, it's hard for me to get overly bearish euro in these conditions, unless unfortunately the situation gets much worse in Ukraine. The one thing that's kind of interesting has been this crazy move in cable, which sold hard, traded kind of down on what everybody thought was a relatively dovish BOE, and now it's just come back with a vengeance. Very hard to read, I think, what happens in the UK. I think the UK economy is going to have a tremendous amount of headwinds in front of it. And I'm not really that bullish cable on a fundamental basis, but looking at the chart, you really can't be bearish. This is a very sharp V-shaped bounce. And when cable makes V-shaped bounces, you got to respect them. Obviously, the 32, 33s is a near-term resist. This midpoint could be some sort of a resistance level. But if you look at sort of cable relative strength, this was a bounce, and I would not be short any of the pound crosses right now, just because the price action really is waving you off on that side of the position. Now, looking, one of the more interesting crosses that I actually wanted to look at is Australia CAD. This has been a power move, right? I've actually been on the wrong side of this move for a couple of days, because the thing that I think shocked the market was incredibly strong economic employment data out of Australia, which just powered Aussie higher, and it definitely suggests that the economy there is doing better, and the RBA is going to go on a hiking basis. But I still think that when you're comparing the two sort of calm dollar giants, the persistent bid in oil, and also similarly strong economic performance in Canada, really argues to me that this is a very decent, this 94, which has been a pretty much a cement ceiling really since the beginning of the year, is a pretty decent area for shorts. I mean, I'd love to, I'm not wrong. I'm early. Well, let's just see how early I am. But I do think that clearly this is a much better entry than maybe over here. So this whole 93 to 95, let's just say a 93 to 95 scale up short. If we break out 95s, clearly I'm absolutely wrong. There is some kind of a structural weakness in Canada that I'm not seeing, and some kind of a structural strength in Australia that I'm not seeing. But overall, I think sort of like the best news out of Australia is done. There's still significant amount of tension with China. There's also, by the way, I think people may be underestimating the slowdown in China, which is very significant. And that kind of a regional slowdown definitely augurs poorly for Australia, whereas the U.S. economy, people are underestimating the U.S. strength. U.S. Employment data has just been monstrous. I know about inflation, I know about oil price and everything else, but it really doesn't matter. Everybody's got a job, which is the far more important thing versus $5 a gallon gasoline. And that ultimately spills over, of course, northward to Canada, which also is getting a double whammy of a very, very strong bid oil. I mean, oil stays at 100 for the next 2 or 3 months. Hard to imagine how this cross doesn't kind of top out here and retraces back on Canadian straight. So that to me is the more interesting thematic ideas into next week. It's going to be very much, I think, a much quieter, calmer, range building week. And therefore, the trades are not going to be nearly as obvious or clear to everybody. But of course, as always, we're watching for headline risk, and we'll see how things develop. I wish you guys all the best in trading. I'll see you guys next week. Boris Schlossberg, over and out.